You are listening to chartingwealth.com's comprehensive review and forecast for the week beginning Monday, the 22nd of October, 2018. Our book is for sale. You want to support the channel, buy the book. You'll see information about how to purchase it in the show notes, and there's a video at the end of today's review. So let's jump into this market. We see the S&P 500 down for the week after we had that weekly vertical crossover for the week ending the 12th of October. And again, the magic of the weekly vertical crossovers, market is moving in the direction of that crossover. You know, it tends to happen like clockwork, doesn't it? Well, on Friday, the market was down 0.07%. It, of course, made for a strong down week. Derivative oscillator gaining downward momentum. Price percent oscillator heading down. We look at the two-day chart. What do we see? It kinked over the last two-day candle, actually moving down quite strongly as far as the price percent oscillator goes. Derivative oscillator lost a little bit of energy, but still heading down. And of course, we ended with a red spinning top. It means some indecision tending down. We have broken what would have otherwise been a nice, strong two-day trend line, but again, still moving in that direction. And we go from the two-day chart to the 4-hour. What do we see here? Well, we see that things are still in a pullback. We don't have a crossover going down yet to put us into this because we can see a sideways slide going on again, tending down. Price movement is above that prior two-day trend line. We'd like to see things crank over stronger. And again, be on the lookout at the beginning of the week for a 4-hour crossover. After this pullback, it will be your trigger for jumping into a down move. Okay, that's what we're looking for over the course of this next week on the S&P 500. That's what we want to see. And when we see that, it will be our trigger to jump into a practice trade on a down move. That's an inverse. So again, we're going to put at the end of this training because I feel like you probably need a repeat of that. Inverse funds, how to make money when markets crash. So please, if you're not familiar with shorting the market or using an inverse fund, please watch that training video. We'll have it linked at the end of it just for you. Okay, now let's go back to the charts. We're going to go from the S&P 500 to the Nasdaq 100 is represented by QQQ. Another down week, Nasdaq down 0.08% for the day on Friday. We can see that price percent oscillator spiking down along with the derivative oscillator on the weekly chart. Don't forget, this is the going into the fourth week now since we had that weekly vertical crossover going down back on September the 21st. Now, the Nasdaq 100 slid sideways for 2 weeks and then cranked down over the last couple of weeks. We go from the weekly to the two-day. Derivative oscillator losing a little bit of momentum, downward momentum, but that price percent oscillator spiking down. And of course, this latest candle is a red down candle, a bit of a spinning top, not as strong as the 4 candles from the 5th through the 15th of October, but again, some down movement with that price percent oscillator, our main indicator, giving us that downward momentum. And we go to the 4-hour chart. What do we see? Again, we had a beautiful down move where we did quite well in our vertical trade, our virtual trade rather, on something like QQQ. I guess it's PSQ, which is a single inverse. A double inverse is, of course, QID. So again, look at those. Take that training that we have on inverse funds so that when you do see this rotation over going down, derivative oscillator losing momentum, price percent oscillator appears to be heading toward that red signal line. When and if that crosses over in the course of this next week, it would be your jumping in point for a down trade. Why? Because the weekly and the two-day are both in confirmed down moves. That'll give you a jumping in for another chance to catch some movement on a down trade in the Qs. That's where we are on the Nasdaq 100 on both of our stock ETFs. Now we go to 20-year bonds. Now remember, on 20-year bonds, we had a weekly vertical crossover going down back on the week ending the 14th of September. Lots of down movement. This is the first week where we've seen any green. But again, price percent oscillator and derivative oscillator still spiking down strongly on that weekly chart. Ended the week 0.20% down on Friday. And we see, of course, a red down candle on the 2-day chart. Now that derivative oscillator continuing to lose downward momentum. Price percent oscillator heading down, but not super strong. Price movement is well below the weekly, but above the 2-day. We go from the 2-day chart to the 4-hour. What do we see? Looks like we're getting close, but hasn't happened yet. So again, watch at the beginning of the week and see if you get a crossover going down. You might have an inverse trade on TLT also. So we got a lot of things shaping up. In fact, all 3 ETFs we've reviewed so far for potential down moves over the course of this next week. Be prepared and ready for that. Use your trade worksheet so that you can track your thoughts and how successful you were if indeed these things come to fruition. So we go from the 4-hour chart on 20-year bonds back to the weekly, and lastly we look at gold. What's going on with gold? Well, of course, gold rotated over. It's the only one going up. That happened back on the 5th of October. We had been seeing gold track sideways for so long, hopefully bottoming out, which it appears to have done. And we're going into our 3rd week of up movement, really the 2nd week of some strong up movement after that weekly vertical crossover. And again, gold up 0.09%, derivative oscillator gaining upward momentum, price percent oscillator heading up on that weekly chart. We look at the 2-day, and of course, we see the latest candle is a bit of a red candle. It's not a solid red candle, but it does give us a little bit of pause as far as the Heikin Ashi candlesticks go, and there'll be a training on Heikin Ashi candlesticks for you also. If you don't understand, those are calculated differently than your typical candlestick. Heikin Ashi in Japanese, I'm told, means average pace, and that's what that attempts to measure. Derivative oscillators gaining upward momentum, price percent oscillator heading up, but we have fallen below the 2-day trend line. What we're really looking at is what's going on with that 4-hour chart. Been warning you as it's been slipping sideways, might be getting close to crossing over, going down. Derivative oscillator crossed over in the morning, as did the price percent oscillator, very close. I'm not going to call it that, but the derivative oscillator has crossed over. Price percent oscillator is trying to. We'll keep an eye on things. I would not be in gold right now on a practice trade just because of the way it ended up the day, particularly after this long slide. So we can just hold things, watch and wait. If it bounces off the red signal line and starts to move up, or even if it crosses over going down, as long as the 2-day and the weekly remain in an up position, once that pullback ceases to be and moves back in the up direction, we can jump in. So keep your eye on gold. Maybe we'll have an opportunity for a trade this next week. This is the fall-winter trading zone. Lots of exciting stuff going on after the summer doldrums. You remember how boring the market got then? Well, this is the fall-winter trading zone, and it is a completely different atmosphere. So pay attention. Study with us every day. Keep up on those daily market and weekly market worksheets. PDFs are attached in the show notes. And again, if you want to support us, buy our book. And we'll put a training in there on the daily market worksheet also, so you understand how to use it and how valuable it is. God bless, my friends. All the best from the whole team here at Charting Wealth World Headquarters.